Commodities took a hit in 2018, but can things turn around next year? Joining me now is Ed Egilinsky, Managing Director of Alternative Investments at Direxion. Ed, welcome back to the studio. Nice to see you again.
Thanks for having me.
So let's start by talking energy prices here. Obviously taking a hit. What does this tell us about the global financial environment here?
Well, I think it's a supply and demand issue. On the supply side right now, you have a little bit of an overhang in supply as a result of the Saudis increasing output. I think they expected the Iran sanctions to have a bigger impact on what Iran would put into the oil market. You have U.S. Right now supplies in terms of what their output is at record highs. On the demand side, the global demand side, you do have a little bit of softening in the economies right now, particularly in Europe and Asia. Germany right now had its first contraction in their economic numbers in a number of years. And the PMI in Japan and China are getting a little softer.
So would you say it's the commodity that's been most affected by the trade wars?
No, I would not, because previous to this pullback, energy was the one area that was strong this year.
So who do what do you think there's one that really took a hit here as a cause of the trade wars?
Well, I think copper and
Right.
soybeans certainly probably have the most direct impact on the U.S.-China trade wars.
On the gold front, Ed, do you feel that gold has been tracking oil?
No, I don't think so. Gold has been down the majority of the year, and energy was up until recently. I think gold has been more due to the fact of a strong dollar and the Fed rate hikes. I think those have probably been the two biggest deterrents to gold and metals in general.
Do you think that's going to remain the case next year, or can gold turn things around here?
Well, certainly if we get a settlement in the trade wars with China, I believe that the dollar would probably weaken a little bit. Also right now, the Fed in the U.S. is concerned about a global slowdown. And as a result of that, maybe the Fed will cease to tighten as much as they are. If those two factors take place, then I would say it would be favorable for gold.
Ed, what's your gut feeling? Which way do you think the Fed will go?
You know, we're not in the business of predicting. The Fed's certainly going to make a rate hike in December, you figure. I think next year they'll have to look at the economic data. And if GDP starts dropping a little bit here in the U.S. and the global markets soften more, then I think the Fed might put the brakes to some of the rate hikes that they're anticipating.
Are you repositioning your ETF?
Well, our ETF is based on completely a rules-based approach. We track an index. It's long a commodity if it's showing a favorable price trend, in cash with a commodity if it's showing a downward price trend. As you know, most commodities right now are in a downward trend. As a result of that, the strategy is defensive. We only have two commodities we're long right now, natural gas, which has had a tremendous run-up even during the energy pullback, particularly with crude heating oil and gasoline. That's been the exception. We're also long sugar, as there have been some supply concerns there.
So if I had to ask you to pick one star that you think could be the breakout star of 2019 in the commodity space.
I think it would be copper from the standpoint of a deal with China and also Chinese stimulus within their economy to boost the industrial metals.
I know we have a lot of silver investors watching out there. It's been a tough ride for silver bugs out there. You come bearing any good news on that front?
Well, I will say people that look at the gold-silver ratio right now, it's at 20-plus year highs. So that means silver is very cheap relative to gold. Also, net short interest in silver is at historic highs. So if you believe that there will be a short covering rally, that could help silver as well.
Ed, thanks so much for your thoughts.
Thanks
for joining us for this
having me.
Outlook. Thanks.
Bye-bye.